Lesson 11. How your stops get hunted and what to do about it. Welcome to Lesson 11. My name is Sam Eder. I'm a global macro currency trader and the owner of FXRenew.com. This is the advanced Forex course for smart traders. Market wizard Bruce Kovner said, "When I enter a position, I have a predetermined stop. That is the only way I can sleep. I know when I am getting out before I get in." Have you ever had your stop hit at what turned out to be the low? Was it just bad luck, or is there something more at play? The chances are there actually is. Forex trading is a zero-sum game. One person's loss is another person's win. You can bet that strong players with more information, more money, and the ability to move the market are out to get as much profit as they can. This means that retail players left holding the weak hand, i.e. with stop losses, had better watch out. But the dealers can be beat. By sidestepping traps and learning how to place your stop loss in places that are difficult to hit, you could add significantly to your trading bottom line. The first step is to understand dealing ranges. Gary Belfoot said, "The most important thing is to have a method of staying with your winners and getting rid of your losers." How dealing ranges influence the price. Dealing ranges drive market behavior. A dealing range is simply a high and low for a trading session or a time period, such as a day, week or month. Dealers use these levels to work out their orders and manage their positions. You can see here examples of dealing ranges on the 15-minute chart of the Euro-USD. The arrows denote dealing ranges. Dealing ranges exist on multiple time frames. They are imprecise. The edges of the range are often pierced and the levels the dealers use for reference are fluid. You will notice an old dealing range will often form the basis for a new dealing range, i.e. they act as support and resistance levels. This is a type of market structure that is tradable and can provide you with an edge. In this chart you can see how old dealing ranges are used as reference points for new ranges. Everywhere where is marked with the red dot, this is the case. Traders who are taught to put their stop losses behind support and resistance levels will often put their stop loss orders behind dealing ranges. The problem for those traders is that their stops then become a target for those that want to be on the other side of the trade at that price. This is true of any major level. On this chart I have marked with red dots where a move has taken out stops before reversing above or below either the dealing range or a support and resistance level. You can see how often your stops will be taken out if you are not careful about your entry or where your stop loss was placed. The solution is simple, right? Widen your stops and don't put them so close to the edge of a dealing range? Not so. There are other factors to consider first. Market wizard Martin Taylor said, "I am wrong all the time. If I can be right 60% of the time, and when I am right I have some big winners, and when I am wrong I staunch the losses quickly, I can make a lot of money." Tight stops improve the risk-to-reward ratio of your trades. When you do win, you will make more with a tight stop if you risk the same amount. But wide stops can improve the quality of your system. If you have a wide stop, you will in general improve your winning percentage, increase your flexibility when managing your trade. If your stop is further from the market, it will give you more latitude on your entry. If you get the general direction right but not the exact timing, a wide stop will allow the market to move against you a little before settling in your general direction. This means that you will on average have more winning trades than if you have a tight stop. Stop losses are inextricably linked to your entry strategy and trade objectives. Your stop loss should be a logical extension of your entry strategy and the objectives you have for the trade. For example, if you're a trend follower looking to catch a breakout, you might have a tight stop loss that you expect to get hit more often than not. Or if your goal were to have a 3-to-1 risk-reward ratio in your trades, you would have a tighter stop than if you were going for 1-to-1. Logically choose a stop that fits holistically into your trading strategy. Psychology and stop losses. Losses can be difficult to take as traders like to be right and would prefer to avoid taking losses. The trick is not to associate loss with failure. Instead, it's important to see a loss as a cost of doing business, i.e. the results of any one trade don't matter. Rather, it is the distribution of outcomes over a series of trades that matter. In other words, you will win some and lose some, and it is what you end up with over time that matters. Some traders even find it helpful to think of trading as a game. Another psychological challenge with stop losses is that the more losses you have in a row, the less confidence you will have in your system. The next trade after a big loser will be more difficult to take, even if you know over the long run that your system performs profitably. When you develop your stop loss strategy, you need to consider your ability to continue to execute your system even after a series of losses. If your stop losses are too tight, then even if you do have the occasional big winning trade that pays for your losses, you might find it challenging to continue to execute your trades in the face of this series of losses. Market types and stop losses. As the market types shift and change, so should your approach to the markets. This goes for stop losses too. Consider whether your stop loss placement is suited to the current market type. In addition, be prepared to change your strategy for your stop loss if the market type changes during a trade. Market wizard Michael Platt said, "When I am wrong, the only instinct I have is to get out." Superior options for stop loss placement. Your main considerations for stop loss placement are the dealing range, the risk-reward ratio, the entry and trade objectives, the market type, and when your idea is proven wrong. Understanding this, here are some different strategies for placing stops that you can help to improve the profitability of your trades. Classic support and resistance stop loss. The classic place for Forex traders to place stops is behind support and resistance levels. Just be aware of the stop hunting intentions of those participants who can move the market. You could put your stop, say 7 to 25 pips behind the level, which will help you to avoid some of the whipsaws. But remember, this will impact the risk reward on the trade. Shakeout stop loss. This is perhaps a smarter way to place your stop loss. Wait until after the stops have been hunted and the price has reversed before you enter. Then place your stop loss either directly behind the support or resistance level or even slightly inside it to improve the risk reward on the trade. On the following chart you can see how once the stops have been taken out, where there's the thin red line, it is safe to place your own stop loss, the thick red line. Indicator stop loss. Indicator stop losses can be quite useful for three reasons. They give you a consistent place to put your stop that requires little discretion. They are, or should be, relevant to your entry and trade objectives, and the stop will not be in the usual place that other market participants are targeting. For example, you could put your stop loss on the 100 period moving average, like in this example, on the 15-minute chart of the USD yen. The mid-air stop loss. To avoid being stop hunted, a mid-air stop loss is just a ticket. Mid-air stops are set far enough away from the edge of the range to make it difficult for it to be hit. In addition, as your stop is likely to be on its own and not grouped with a bunch of others, there will be little point in others going for it anyway. Mid-air stops work best when trading directly off support and resistance levels. You simply place your stop far enough away from the dealing range that it will look like it is hanging in mid-air away from the action. A special note on break-even stops. Break-even stops are a hot topic for traders. There are both pros and cons for break-even stops. Only you will know what is right for you. On the one hand, a break-even stop is a powerful psychological tool. It ensures your winning trades don't turn into losing ones. This means that your winning percentage will increase, which can make it psychologically easier to follow your system and trade mistake-free. On the other hand, if you move your stop loss to break-even, you may end up putting your stop in an illogical place that the dealers can easily go for. In my experience, although this can mean you have less losing trades, you actually make less profit overall. The winning trades you do miss out on will reduce the profitability of your system over time. This means you are faced with a choice. Which is more important to you, consistency or profitability? Now it becomes a simple matter of testing. Try adjusting the following combinations to see what suits you. The risk-reward ratio by tightening and widening stops, the stop-loss method. Always think about the dealing ranges, keep in mind where the market is likely to move to next, and avoid putting your stop in places that are easy to hit. Remember, your loss is their gain. In the coursework for this lesson, add your stop-loss method into the trading plan. I'll see you in the next lesson.